What if a long-term investor combined SCHD or the Schwab US Dividend Equity ETF with the Schwab US Large Cap Growth ETF and gained massive exposure to huge dividends and massive dividend growth, but also exposure to some of the fastest growing large cap companies in the world that's most likely going to grow their net worth significantly over time? Well, in this video, we're going to go over exactly that and what this would look like by combining both SCHD and, of course, their sister or brother SCHG. So if you love dividends, but you also love growth, I promise you're going to want to stick around for this one. So make sure to drop a like down below and subscribe, and let's get right into it. Real quick, for those that haven't already, make sure to go to the first link in my description and grab my new dividend investing ebook, where I share exactly how I went from $0 invested to now earning over $6,000 on a monthly basis and over $1 million invested in the market. Along with the ebook, you're also going to receive my custom dividend tracker, where you can track your dividend progress on an ongoing basis and reach your dividend investing goals. So make sure to grab yourself a copy of my dividend investing ebook and the new dividend tracker today. It's the first link in my description. Now first, just to go over some of the basics, I'm talking about SCHD, the Schwab US Dividend Equity ETF, the ETF that is known for having massive dividend growth historically, and the ETF that most of us dividend-focused investors are sort of obsessed with. But we're talking about combining it with the lesser popular as far as in the dividend community. SCHG, this ETF has had massive growth over time, and this is of course because its objectives are much different than that of SCHD. Now first, to go over what the Schwab US Dividend Equity ETF is and how this ETF works, it says the fund's goal is to track as closely as possible before fees and expenses the total return of the Dow Jones US Dividend 100 Index. Now I can make a whole video going over what this index is, how it works. I've actually done so in the past, so definitely check out my channel and subscribe for things like that. But this index basically has some of the best, highest quality dividend-focused stocks within it that also have a history of raising their dividends over time. Now, as far as the ETF goes, the highlights: a straightforward low-cost fund offering potential tax efficiency. The fund can serve as part of the core or complement in a diversified portfolio. It also says tracks an index focus on quality and sustainability of dividends, and also invests in stocks selected for fundamental strength relative to their peers based on financial ratios, which is what I was talking about a second ago. Now, even though SCHD is of course dividend growth focused for the most part, this ETF actually has grown a lot over the years. As far as just price appreciation, we're talking almost 240%. Not to mention, SCHD has a 3.39% dividend yield trailing 12 months and has had some massive dividend growth historically. Now, the reason I personally buy so much SCHD, for example, is because I personally want exposure to massive dividend growth over time. I want to get paid more and more for just holding onto a simple asset long term. But before we go any deeper into SCHD, let's talk about SCHG. Now for this ETF's objective, it says the fund's goal is to track as closely as possible before fees and expenses the total return of the Dow Jones Large Cap Growth Total Stock Market Index. The highlights are a straightforward low-cost fund offering potential tax efficiency. The fund can serve as part of the core of a diversified portfolio, and simple access to large cap US equities that exhibit growth style characteristics. Stocks are classified as growth based on a number of factors. So again, the idea of this video and the idea of this portfolio is combining two powerhouse ETFs that are both very cheap to hold on to. We're talking 0.04% and 0.06%. The expense ratios are cheap. These ETFs are both extremely diversified. They both have insane total returns, which I'm going to show you in a second. And by combining both of them, you're getting exposure to massive dividends, massive dividend growth, diversified portfolios, and with this one, massive growth potential for your portfolio. Now, as far as the holding breakdown goes, this right here is for SCHD, the dividend one. We're talking Home Depot, we got BlackRock, Cisco, Bristol Myers, Lockheed Martin, Verizon, Chevron, Pfizer, UPS, and Texas Instruments. Around 100 names altogether, names that, like I said, are going to continue to probably pay dividends and probably going to keep raising their dividends historically. And if not, they're going to be basically kicked out of the fund during the yearly reconstitution. Now, SCHG, for example, the growth ETF, this ETF gives you massive exposure to things like Apple stock, Nvidia, Microsoft, Amazon, Meta, Google, Broadcom, Google, Eli Lilly, and of course Tesla. Names that are not going to be dividend or dividend growth focused. These names are going to potentially get investors very rich very fast during bull markets. Now, to dig a little bit deeper into SCHG, which also just did split just like SCHD as of recently, and both these ETFs as of right now are trading just shy of all-time highs as a side note. But on the 1 year time frame, SCHG is up 40+% on the 1 year. Year to date, 27+% on the max time frame. This is since 2009. We're talking 733+%. Now, the first thing you guys might be thinking is, well, this all sounds great. This video sounds like a decent idea so far to combine SCHD to G, but why would an investor not just invest solely into SCHG, the growth focused one that has grown substantially over time? And my simple answer to this would be, well, of course, if that investor wants to do that, then go ahead and do it. But for an investor that does sort of favor dividends and dividend growth like me personally, and is sort of trying to grow their portfolio in a little bit of a slower steady sort of fashion, then maybe combining both SCHG and D could be a good option for some investors out there. And the cool thing is if you're more focused on dividends, maybe buy more of this one. If you're more focused on growth, maybe buy this one. But either way, both these ETFs have grown significantly over time in their own ways. Now, to give you some actual numbers, over the last 13 years now or so, SCHD has grown 402% as far as total return goes, and this is with dividends being reinvested, or around 13.23% on average per year. Not bad whatsoever if you ask me. Now, SCHG is a little bit of a different animal. We're talking 16+% per year on average with dividends reinvested, or around 810% over the last 14.79 years. This ETF, I cannot lie, has been an absolute monster. Now, the cool thing about building out a long-term portfolio is you can combine two ETFs, one that focuses heavily on growth, one that focuses heavily on dividends or dividend growth, or you could buy some of each, some of the other. You can buy a ton of different ETFs and build out a long-term portfolio that reaches the needs of exactly what you're looking for. Like take my portfolio right here for a second that currently pays me on average around $7,500 per month in dividends. Now, this portfolio I've been building for around 8 or so years, and I have certain positions in this portfolio, like my 1,001 shares of Apple stock, which I of course did not buy for dividends, I bought for growth potential. But then there's also names in here like Verizon stock. I have 1,262 shares of this one, which I bought Verizon mostly for a decently high starting yield and some slow and steady dividend growth historically. But throughout my portfolio, if you look around at all the different stocks and ETFs that I currently hold on to, you can sort of get an idea of what I'm looking for as far as an investment objective. And that for me personally is that I want to buy into stocks and or ETFs. They're going to grow over time, maybe some faster, maybe some slower, but I also favor dividend income because I'm looking to potentially use this dividend income in this portfolio to pay for things like my bills, help family and friends, etc. in the future. So just to circle all the way back to the idea of combining something like SCHG, which of course is much more growth focused, and something like SCHD, which is more dividend growth focused, both super solid ETFs that have an awesome track record, I think this could potentially be a great option for those investors out there that haven't really made up their mind on whether or not they're focused on dividends or whether or not they want some more exposure to growth. So now that we went over the idea of combining these two ETFs or combining whatever else the case might be, I lastly want to hear from you guys down below. If you were forced to only be able to invest into SCHD or SCHG, which one would you choose and why? Let me know in the comments down below. If you enjoyed this video, make sure to please drop a like on it and subscribe for more future content like this. Thanks as always for stopping by, and if you are interested in investing, make sure to check out these recent videos I posted right here.